Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And as crazy as it may sound, you can make $70,000 a year in retirement tax-free. Last week, we put out a video going over income taxes and how it affects your paycheck while you're still working. In retirement, the tax system works a little bit different. If you are receiving Social Security, the tax system is set up for you to have a major advantage if your retirement income plan is set up properly. The greater the percentage of your income that comes from Social Security, the less you're going to pay in taxes. And as clickbait as the title of this video is, I have seen this happen personally. I have worked with clients who have brought in $70,000 a year of income and not had to pay any taxes on it. In this video, I'm going to show you how it's possible. Stay tuned. So to show you how this is possible, the first thing we need to understand is how the tax system works for retirees, and specifically the ones that are receiving Social Security. Now, if you weren't aware, your Social Security benefit could be subject to taxes depending on how much income you have coming in. Now, the first thing we have to figure out is how much of your Social Security benefit could be subject to taxes. Now, in this example, we're going to assume that we have a 65-year-old couple that are married filing jointly. We're going to assume that they have $22,000 of taxable income coming in. Now, this could be from a pension, it could be a pre-tax retirement account distribution, but it's $22,000 of taxable income. The next thing we have to figure out is how much is their Social Security benefit? Well, we want to bring in $70,000, so their Social Security benefit is going to be $48,000. And what this breaks down to is $2,000 per month per person. And this is very reasonable for a lot of people that are 65 years old and retiring. So if we add that up, that's $70,000 of income. Now, to figure out how much of that Social Security benefit may be subject to income taxes, we have to do some math. And this is actually a two-step process. The first thing we have to figure out is what is their combined income. Combined income is your AGI, or that taxable income, plus your non-taxed interest, plus 1/2 of your Social Security benefit. So for our example couple, they have $22,000 of income that's taxable. We're going to assume that they don't receive any untaxed interest just to keep this example simple. And then we're going to add $24,000 as the 1/2 of the $48,000 of Social Security benefit that they receive. If we add all of this together, their combined income is $46,000. This is step number one. The next step is we have to take this figure and compare it to the IRS thresholds of determining how much of your benefit could be subject to income taxes. Now, those thresholds, if you're married, and this is as of 2024, anything from $0 to $32,000, none of that is going to count towards your taxable Social Security. Any of your combined income that falls between $32,000 and $44,000, 50% of that amount counts as taxable Social Security. And then anything over $44,000, 85% of that amount can count as taxable Social Security. And this lasts all the way up until 85% of your Social Security benefit. So up to 85% of the money that you receive from Social Security could be included as taxable income. In this example, we're not even going to get close. But the way this works, their combined income is $46,000. So for the first $32,000 of that amount, none of that's going to count. From $32,000 to $44,000, 50% of that amount is going to count. Because their combined income is $46,000, they're going to fill up that bracket. There's $12,000 within that bracket. We multiply that by 50%. $6,000 of their Social Security benefit is going to be included as their taxable income. They also have an additional $2,000 that goes over that $44,000 limit. We multiply that by 85%, that's $1,700 of their Social Security benefit that's going to be subject to income taxes. We add these up. The grand total of their Social Security that could be subject to taxes is $7,700. So we've done all of that math just to figure out how much of their Social Security benefit is going to be subject to taxes. We have to take that figure and add it to their taxable income to figure out what their tax bill is going to be. So they have the $22,000 that comes in from their pension, their pre-tax retirement account, wherever it comes from. We're going to add to that the $7,700 of taxable Social Security. We add these two figures together. Their adjusted gross income is $29,700. Now, this is their adjusted gross income. The next thing that we have to take into account is what their standard deduction is. And in 2024, the standard deduction for married filers is $29,200. If you're 65 years old, you get an additional standard deduction. As of 2024, it's $1,550 per person that's age 65 or older. Again, to make this example as easy as possible, we're going to assume that they're both over the age of 65. So if we take that $29,200, that's the standard deduction for all married couples, and we add to it the $3,100 for our 65-year-old couple, their total standard deduction is $32,300. We're going to take that $32,300 and we're going to subtract it from their AGI. This is going to leave them with a taxable income of negative $2,600. If you report a negative taxable income, then there are no federal income taxes that you're going to owe. So they have received $70,000 in income, $22,000 from their pension or pre-tax account, $48,000 from Social Security, and they owe absolutely no federal income taxes. Now, if you live in the state of Virginia like I do, or any other state that collects state income taxes, sure, you may have to pay taxes to the state. I actually ran the numbers for the state of Virginia. If you make this $70,000, you owe $94 to the state of Virginia as state income taxes. But from a federal standpoint, a 65-year-old couple can bring in $70,000 and not have to pay any federal income taxes on that amount. And this is the importance of understanding how taxes work in retirement. They're completely different than the way they were while you were working. You can bring in $70,000 a year of income and not pay any taxes on it. It's all about how your retirement income plan is structured. If you understand how your sources of income are going to be taxed, you can fit them all together to be in this type of situation. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone who's worried about their taxes in retirement, then send this video to them. It may help them realize that it's not as bad as it may seem. But I thank you so much for tuning in. I'll talk to you soon.